What if I told you that with one single purchase, you could own a tiny slice of 500 of the biggest companies in America? Apple, Microsoft, Amazon, all of it, for less than the price of a nice dinner. That's not a fantasy. That's exactly what an ETF lets you do. Let's break down what an ETF actually is, how it works, and why so many investors, from total beginners to Wall Street pros, use them. What is an ETF? ETF stands for Exchange Traded Fund. In plain English, it's a basket of investments, stocks, bonds, or other assets, bundled together into a single fund. That fund is then divided into shares, and those shares trade on the stock exchange, just like a regular stock. So instead of buying one share of Apple, one share of Microsoft, and one share of Google separately, you could buy a single ETF share that already contains small pieces of all of them, and often hundreds or thousands of other companies too. How it works. Here's the simple version. A fund company, like Vanguard, BlackRock, or State Street, creates a fund and decides what it will hold. Some ETFs track an index, like the S&P 500, meaning they simply hold the same companies in the same proportions as that index. Others focus on a specific sector, like technology or clean energy, or an asset class, like gold or bonds. That fund is split into shares, which get listed on an exchange under a ticker symbol. Think SPY, VOO, or QQQ. When you buy a share of that ETF through your brokerage account, you're not buying stock in one company. You're buying a tiny proportional stake in everything the fund holds. ETFs via mutual funds via stocks. You might be thinking, isn't that just a mutual fund? Good instinct. ETFs and mutual funds are cousins. Both pool money from lots of investors into a diversified basket. But there are two key differences. First, ETFs trade throughout the day on an exchange with prices moving in real time, just like a stock. Mutual funds only trade once a day after the market closes at a single set price. Second, ETFs are typically more tax efficient and often have lower fees, especially the ones that just passively track an index rather than having a manager actively picking stocks. And compared to buying individual stocks, an ETF gives you instant diversification. If one company in the fund has a bad quarter, it's a small piece of a much bigger picture, so your overall risk is spread out. Why people use them. So why are ETFs so popular? 3 big reasons. Diversification. You're not betting everything on one company. Low cost. Many popular ETFs charge less than 0.5% per year in fees. And simplicity. One purchase gives you exposure to an entire market, sector, or strategy without having to research and buy dozens of individual stocks yourself. That's why ETFs have become a go-to building block for retirement accounts, long-term investing, and beginner portfolios alike. Types of ETFs. Quickly, here are a few common types you'll come across. Index ETFs track a broad market, like the S&P 500 or the total U.S. stock market. Sector ETFs focus on one industry, like healthcare or technology. Bond ETFs hold a basket of government or corporate bonds. And commodity ETFs give you exposure to things like gold or oil without you having to own the physical asset. Risks to know. Of course, ETFs aren't risk-free. If the market drops, your ETF drops too. Diversification reduces risk. It doesn't eliminate it. Some niche or leveraged ETFs can be volatile and aren't meant for long-term holding. And fees, while usually low, still vary, so it's worth checking the expense ratio before you buy.